Let me now bring on board Manish Kumar, Head of Investment with ICICI Prudential. He joins us live. Manish, morning. Thank you for joining us. Manish, April has been a very volatile and unpredictable month for Indian markets. First, we saw a gut-wrenching fall, and now we've seen a majestic recovery.
You are right, Nikunj, but as somebody said, if actually when one looks at the behavior of some of the global commodities in the last 2 weeks, I would say at the margin things are looking much better for India, and therefore even if it means some volatility, I think it is for the better. And what we are saying is that at the margin the macro is looking much better for India as a whole.
Manish, I'm in sync with you when you say that because of crack in commodity prices, the macro is looking better. But what about earnings?
See, there are two sets of fundamental factors that have been having an impact on the markets. One is the macro factors and the other is the corporate earnings. Now, for the last couple of years, we have been saying that there are two major negatives on the macroeconomic front. One is inflation, the other is the twin deficits. Now, because of the behavior of the global commodity prices, and especially oil, I think these two macroeconomic factors are turning favorable. And that is something which is quite positive for long-term equity investors. Now, as far as corporate fundamentals are concerned, it is partly a function of what has happened in the past and partly a function of the investment paradigm that is prevailing currently in the country. So that is typically there is a time lag between what happens on the macro front and what happens on the corporate fundamentals. So in a way you are right that the corporate earnings growth is likely to be muted for the quarter. It may be around say even 0% on an aggregate basis for the March quarter. And yes, therefore there will be some lag between the improvement in macro fundamentals and the improvement in corporate fundamentals.
Do you want to comment on the Jet Etihad deal and what it means for the aviation sector, which has been largely a write-off for a while?
Well, as a matter of company policy, we do not comment on individual instances or individual deals. But as far as aviation sector is concerned, we have been largely out of that sector.
And that view continues post the deal?
As of now, the view stands.
Okay, what's the call on the private sector banks right now? HDFC Bank came out with earnings that met expectations, been a consistent performer there. Axis Bank showed good improvement in their margins. Asset quality remains stable. What's the specific view on large cap private banks, and does the bullish stance stay?
Well, we have been bullish on this private sector banking space for several years now, and that stance keeps getting vindicated time and again, and that stance has remained so far. In fact, even when people have been raising concerns on high interest rates, this is one space which continued to do quite well, and now when interest rates are likely to come off, I think this space will continue to do even better.
Manish, the script of how Indian markets moved for FY13 was largely dominated by Europe, global liquidity and defensive quality stocks.
Right.
What do you think will impact the script for FY14?
Well, in a way you are right that the factors that were impacting the markets last year may not necessarily be impacting in the same way this year. In fact, 1 year back, if you recall, we were quite negative on the fundamentals of the corporates as well as on the economy. However, what we mentioned was that, look, the liquidity paradigm is very, very benign, and that will keep supporting the markets. And that is why we said that the markets are likely to be range bound. Now, going forward, what is actually happening is if there is a fall in global crude prices or global commodity prices, it is partly also because there is a perception that US will gradually start withdrawing liquidity. And if that were to happen, then the global liquidity flowing into India may not be as benign as it has been historically. So the way the markets may behave is that fundamentally things will start improving for the Indian economy, but the flows, as far as foreign flows are concerned, may start looking little more moderate as compared to what we saw last year.
And is that a concern, Manish? Because, up until now, Indian markets really been a one-trick pony for Indian equities, which is that they are only reliant on global liquidity. If you are making a case that in the coming quarters, we really could be staring at poor global liquidity, and in the absence of any domestic support, what happens to equities?
Well, last year was a very peculiar year in our career as well, because while FIIs invested almost $26 billion in the last financial year, domestic institutions also sold almost $13 billion, and that has not happened in the last decade. So now with gold prices coming off, there is a belief, and we also believe that with a lag, there will be some revival in financial savings, and therefore there will be some revival in flow of liquidity to the domestic institutions. So while last year FII flows were very strong and they are likely to be moderate this year, don't expect the kind of selling from domestic institutions that we saw last year. In fact, maybe after 6 months, you may find some of the domestic institutions to be turning buyers.
But that may be just sentimental, right? What you're talking about with the fallen gold prices, and may not be structural. What convinces you that it could bring about a shift in investor behavior?
Typically, what we have observed is that investors tend to chase momentum. So if we go back in time, we had maximum flows in our equity-oriented funds in, say, the December quarter of 2007. In the March quarter of 2009, when the equity markets bottomed, we had maximum flows coming in debt. In the last 5 years, a lot of money has gone into gold. But at least when we look at the dollar price of gold, people haven't really made much money in the last 2 years. In the Indian context, because of currency depreciation, people may not have lost money so far, but now they can start feeling the pinch. So the moment they realize that gold is no longer making money for them, they will start looking at other investment avenues. And in the last 3 years, look at the way financial savings as a percentage of GDP has declined. So I think that is why I said with a lag, people will start moving money, if not out of gold, at least they will start allocating more of their savings into financial assets.
Well, I hope it happens, Manish, because that really is the key overhang for Indian equities, that there are hardly any retail investors. So Manish, at the current juncture, what is your portfolio strategy? At a time when commodity prices have come down, we could be staring at a potential second half recovery in this financial year. How exactly are you realigning or aligning your portfolios?
There have been some calls that we are sticking to, like for example, being positive on the private sector banking space, being positive on the automobile sector. We have been positive on the telecom space, and these stances are not going to change in the short term. Then there are certain sectors where we had taken tactical positive calls. Like for example, technology was one sector where we had taken an overweight call some time back, and thankfully before the earnings season began, we actually as a house had gone underweight. So we have been on the right side of the sector both the times. And there earlier our belief was that if currency would keep on depreciating, which was earlier being forecasted, then it made sense to be heavy in some of these export-oriented sectors. So now one change that we are making is that no longer are we going to be looking at export-oriented sectors based on currency. Because of what is going to happen on the trade deficit front, the chances are that the currency is likely to be range-bound. And therefore, if we have to be invested in export-oriented sectors, it's possibly going to be on the merit of the sector itself rather than currency. Another area where we are looking or getting more positive is the upstream oil sector. Even if the crude were to rally by 5 or 10%, at least on a YOY basis, that base is going to start helping the cause of this sector. And therefore, going forward, even if we have moderate diesel price hikes, I think there is possibly some money to be made in this sector.
Are you also looking at buying industrials? Because that is one pocket which will benefit automatically if the economy reverses.
Well, the reversal in the fortunes of industrials is going to be depending not just on the change in macro fundamentals, not just on change in interest rates, but also on the change in investment climate, which actually depends a lot on domestic politics. And as of now, we do not have much visibility on any significant improvement on that account. Therefore, I think industrials is one space which may actually take time to recover, and we are right now underweight on that sector. Having said that, since it is a space which one would like to look at very closely in a pre-election year, therefore, just to be on the safe side, we are actually overweight on the cement sector. So that is how we are trying to play the industrials space.